Most traders lose money for one reason that almost nobody talks about. They don't lose because indicators don't work. They lose because they're using the wrong settings and taking signals in the wrong direction. If you leave early, you'll miss the part that decides whether every trade you take is stacking in your favor or quietly working against you. On this chart, I'll show you how to identify the market direction, ignore low potential signals, and only trade when everything is aligned. At the end, I'll show you the exact indicator setup that makes this work, because without that, none of this matters. Now look at the Bitcoin chart. Focus on the color line on the screen. This line is foundation of the entire strategy. It tells you who controls the market before you think about entries. When the line is green and price candles are forming above it, the market is on an uptrend. There's no interpretation here. Price is above the line is green, and that tells you buyers are in control. As long as candles keep closing above this line, demand outweighs supply and the market keeps pushing higher. Everything else you do depends on this. If you get the trend wrong, every signal after that becomes unreliable. Now watch what happens later on the same chart. The colored line turns red and the price starts forming below it. The trend now is down. This isn't a prediction. This is a visual confirmation of control. Price below the line, red trend, sellers are in charge. In this condition, buying pressure is weak and buying usually fails. A massive number of traders lose money right here because they treat every signal the same, regardless of direction. Simply knowing whether price is above or below this line already removes a large percentage of losing trades before you ever enter. Now look closely at the arrows on the chart. These arrows are buy and sell signals. They mark moments where momentum might be shifting. Their job is not to guarantee profits. Their job is to alert you that something is happening. The mistake most traders make is reacting to every arrow. The setup only works when these tools are combined correctly on the defined direction. The other provides timing. Watch this example. The market is clearly in a downtrend, and yet a buy signal appears. This is where most traders lose money. Here's the first core rule. We never take signals against trend. This rule exists to protect you from counter-trend trades. Counter-trend trades fail more often and drain accounts slowly. Traders convince themselves they're catching reversals, but most of the time the main trend resumes and stops them out. In this case, the buy signal is ignored instantly. No debate, no exception. Then look at what happens next. A sell signal appears, and nothing about the trend has changed. Price is still below the line is still red, the signal is aligned with market direction. And that alignment is what makes it valid. The signal isn't predicting the future, it's offering a possible entry inside existing momentum. That's the entire logic of the setup. Direction first, timing second. Now comes the second rule, and this is where accounts are either protected or destroyed. We never enter a trade without a strict risk control. Even perfect setups fail sometimes. Without risk management, one bad trade can erase multiple good ones. In this approach, risk is fixed and non-negotiable. We never risk more than 1% per trade. That single rule keeps losses small, emotions controlled, and decision-making consistent. Every trade uses a stop loss. For sell trades, the stop loss goes at the most recent swing high or at the trend line. If price breaks above that level, the trade idea is invalid. For targets, we use a minimum of 1 to 2 risk to reward ratio. That means winners are allowed to outweigh losers even with a modest win rate. The buy logic is identical, just reversed. When the trend is up, green line, price above it, sell signals are ignored. When a buy signal appears in that condition, it's a line. risk stays at 1%. A stop loss goes at the recent swing low or the trend line. Target remains 1 to 2. The rule never changes, only the direction changes. At this point, you understand the structure, you understand the rules, but here's the part most traders get wrong, and this is where the edge actually comes from. The indicators themselves are free. The default settings are the trap. If you use them out of the box, you'll get noise, fake signals, and constant color changes that destroy discipline. Now I'll show you the exact tools and the exact settings that make this work. The signal generator used here is Trend Levels by Chart Prime on TradingView. This indicator produces the arrows you've been seeing. Go to the inputs. Set the length to 27. Lower value creates noise. Higher values delay entries. 27 is the balance point that filters false signals without lag. The trend detector is a smoothed Gaussian trend filter by Algo Alpha. In the settings, set the Gaussian length to 100 so it focuses on true market direction instead of short-term movement. Set the pools at 3 for controlled smoothness and set the smoothing length to 50 to reduce unnecessary volatility. Now set the flatten multiplier to 7 to prevent constant color flipping during sideways markets. In the Style tab, disable all signals options. This indicator defines direction only. It does not generate entries. When these signals are applied correctly, everything clicks. Trend becomes obvious, signals become selective, risk stays controlled, losses stay small, and winning trades are finally allowed to do their job instead of getting out early. The edge here isn't complexity, it's simplicity, alignment, and using the correct settings with discipline. Apply this exactly as shown. If it helped clearly how to trade with direction instead of hope, hit like so more traders see it. Subscribe if you want strategies built on a structure and risk. And I'll see you in the next video. Happy trading.